A stop loss, the deep dive, every trader must watch. Welcome to MarketIQBasics. Today, we are doing a complete deep dive on the stop loss. We have mentioned stop losses in almost every video on this channel. But today, we go deeper. What a stop loss really is, why it is the most important tool in trading, how to place one correctly, and why deviating from your money management stop loss is one of the most dangerous things a trader can do. Let's get into it. What is a stop loss and why does it exist? A stop loss is a predetermined price level at which your trade automatically closes if the market moves against you. It exists for one reason: to protect your capital from large, uncontrolled losses. Without a stop loss, a single bad trade can do catastrophic damage to your account. Markets move fast, especially around news events. A trade that looks fine 1 minute can be deeply underwater the next. The stop loss is your safety net. It defines your maximum loss on every trade before you even enter. Professional traders do not think of a stop loss as admitting they might be wrong. They think of it as the cost of doing business, the price of staying in the game long enough for their edge to work. The money management stop. Never deviate from it. In our money management videos, we established a clear framework. Never risk more than 3% of your trading account on any single trade. For a $1,000 account, that is $30 maximum per trade. This is your money management stop. It is the absolute maximum you are willing to lose on any trade. It is not a suggestion. It is a rule. Here is where many traders go wrong. They place their stop correctly before entering. Then, the market moves against them. Price approaches their stop level, and instead of letting it hit, they move the stop further away. They tell themselves the trade will recover. They convince themselves just a little more room is all it needs. This is one of the most destructive habits in trading. Moving your stop further away does not give your trade more room. It destroys your money management framework entirely. That $30 maximum loss becomes $50, then $80. Then the trade moves further, and suddenly you have lost $200 on a trade that was supposed to cost you $30. One moved stop loss can wipe out weeks of profitable trading in a single session. Small adjustments are different. If your analysis shows a key level $2 or $3 beyond your planned stop, a minor tweak within your 3% limit is acceptable. That is refinement. Moving your stop $20 or $30 further because you cannot accept the loss. That is emotional trading, and it is disastrous. The rule is simple. If the market hits your stop loss, the trade was wrong. Accept it. Take the small loss. Move on. A $30 loss is nothing. A $300 loss because you refuse to take the $30 loss is a problem that takes weeks to recover from. The $30 example was a framework, not a rule. Throughout our earlier videos, we used $30 as the maximum loss per trade on gold for a $1,000 account. This was a simplified framework to make money management easy to understand when starting out. In real trading, your stop loss will not always be exactly $30. It will vary on every trade depending on your setup, your time frame, and market structure at that specific moment. The formula never changes, 3% of your account. But the actual stop loss placement is determined by your analysis. As you develop your system, you will learn to find stop loss placements that are both technically sound and within your money management limit. Sometimes $15, sometimes 25. The goal is always to find a level that makes technical sense, one the market should not reach if your analysis is correct, while keeping total risk within 3%. If the technically correct stop loss would cost more than 3%, you do not widen the stop. You reduce your position size. The formula keeps your risk controlled, regardless of how wide the stop needs to be. Where should your stop loss actually go? You do not want to place your stop where price can easily and naturally revisit. You want it at a location where, if price reaches it, your original reason for entering is invalidated. There are two primary tools for finding the right stop-loss placement: ATR and support and resistance. Used together, they give you both the sizing and the location. Using ATR to size your stop-loss. The average true range tells you how much the market typically moves per candle on your chosen time frame. Your stop must be wide enough to survive this normal movement. Otherwise, you will be stopped out by noise rather than a genuine move against you. Place your stop at 1 to 1.5 times the ATR away from your entry. Let us go through gold across multiple time frames. On the 5-minute gold chart, the ATR is approximately $1 to $3. A stop of $3 to $5 gives enough breathing room for a scalper. Tiny stops, small positions, multiple trades per session. On the 15-minute chart, the ATR rises to $3 to $6. A stop of $6 to $9 is appropriate, enough to survive normal 15-minute fluctuations. On the 1-hour chart, the time frame we focus on most at MarketIQBasics, the ATR is approximately $8 to $15. A stop of $12 to $20 gives your trade the room it needs. For a $1,000 account at 3% risk, a $15 stop allows 2 lots of gold. On the 4-hour chart, the ATR is approximately $20 to $35. Your stop needs to be $30 to $50 from entry. This time frame suits larger accounts or very small position sizes. On the daily chart, the ATR is currently around $50. A stop of $50 to $75 is needed. This is for positional traders holding for days or weeks with appropriate account sizes. The message is consistent across every time frame. Respect the ATR. Never place a stop tighter than the market's natural movement on your chart. Using support and resistance to locate your stop loss. ATR gives you the sizing. Support and resistance gives you the precise location. On a buy trade, your stop should sit just below a significant support level, where buyers have historically stepped in and pushed price back up. If price breaks below that support and hits your stop, the support has failed and your reason for buying is gone. The trade is correctly closed. On a sell trade, your stop should sit just above a significant resistance level, where sellers have historically pushed price back down. If price breaks above that resistance, your reason for selling is invalid. The keyword is just below or just above, not exactly at the level. Price often briefly pierces support or resistance before reversing, a move called a wick or false break. Placing your stop exactly at the level means a wick hits it before price reverses in your direction. Place it a few dollars beyond the level to give it proper buffer. Combining ATR and support and resistance. The most precise stop-loss placement uses both tools together. Identify the nearest significant support level below your entry on a buy trade. Check the ATR for your time frame. Your stop should sit just beyond the key level, and the distance from entry to stop should also be no tighter than 1 ATR. For example, on the 1-hour gold chart, you identify a strong support level $12 below your entry. The ATR is $10. $12 is slightly more than one ATR. Well placed with adequate breathing room. You place your stop $2 below the support, $14 from entry. Technically sound and within ATR guidelines. If the support level is only $5 from entry but the ATR is $10, the support is too close. Normal candle movement will pierce it constantly. Look for the next support level further away or reconsider the entry altogether. The zones you must avoid. There are specific locations where you should never place your stop loss. Never place it at a round number. Prices like $2,000 or $3,000 on gold. These areas attract enormous order flow and price frequently spikes through them before reversing. Never place it in the middle of a range between support and resistance with no technical justification. A stop in open space has no meaning and will be hit randomly. Never place it inside a congestion zone, an area where price has moved sideways multiple times. These zones are contested and price revisits them regularly. Your stop must be beyond the entire zone, not inside it. A practical checklist for every stop loss. Before placing any trade run through this checklist, is my stop beyond a key support or resistance level? Is the distance at least one ATR for my time frame? Does my position size keep total risk within 3%? If the stop is hit, is my original trade idea clearly wrong? If the answer to all four is yes, your stop loss is correctly placed. If any answer is no, adjust before entering. Final thoughts. The stop loss is not a formality. It is the foundation of your entire money management framework. Every decision about where to place it, how wide, which level to use, directly impacts your ability to protect your capital and grow your account over time. The $30 framework in our earlier videos was a starting point. As you develop your system, that framework evolves. Stop losses placed precisely where the market tells you they belong, always within your money management rules, always sized correctly for your time frame. Master the stop loss. Respect it every single time. Never move it against yourself. It will protect you through every losing trade, keeping losses small, manageable, and recoverable. At MarketIQBasics, our mission is honest, complete trading education. If this video helped you, please like, subscribe, and share with someone learning to trade. Check the description for our ATR, money management, and paper trading videos. See you in the next one. Ed Project.